Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor. Matt, why don't you go ahead and introduce the topic for today?
The topic today is 10 things in 20 minutes that are kind of impacting our market, if you will. And the first one in here that we should discuss is, I would say it's more of a factor earlier in the year, but how much product, not only locally but nationally, got pulled and didn't sell in the capital markets.
Yep, there's been a lot, to your point, here and, up and down the West Coast, where there's been a disconnect, certainly between where pricing's been between buyer and seller. And some sellers just said, you know what, we're pulling it off the market. We didn't hit pricing, so we're going to hold it. So that has happened a lot.
It did. I think it's getting better. And I actually think we heard a statistic earlier in the year that 65 to 70% of product that was introduced in the first and second quarter didn't trade.
Yep.
So it got pulled from market. I think the lesson here is, a little fault to brokerage as an industry, that sometimes when you're bidding on projects and, estimate, you're trying to win the business. So you're going to the top, right? You're going to the top and saying, this is what we think we can sell it for. So it sets a buyer expectation. The market was moving at the same time in the downward trajectory, obviously. But I think what brokers have learned through this process is, let's not puff up packages and pricing and set wrong expectations, because we're not in the business of bringing stuff to market just to parade it around and then not trade it.
Yeah, correct. That's right. And there was just a gap, right? People didn't know where pricing was as well, and it was moving quickly. The other thing, I think, the next thing I want to talk about is the discount in pricing, right? A big reason some of that stuff hasn't traded is because your buying pool is probably 20% of what it was before the debt increase.
That's right. Buildings went, let's just talk about the greater Seattle industrial market. I think this could project to the entire West Coast, but through COVID, in that plus or minus 3-year period, we saw about $100 to $120 a foot value in buildings increase, right?
Mm-hmm. Yep.
Due to compressed cap rate and increased construction price and inflated or increased rents, right? I think we've lost $60-ish of that.
Yeah. So if a building was going to trade at 300, during the pandemic, right, we're probably, 220, 230, 240,
that's right,
250-ish today. And so, yeah, there certainly has been a discount. But if you look at, cap rates alone, right, if during the pandemic you called it a 4 cap market, right, and you call today you're at a 6 cap, there's your spread, right?
Absolutely. And I think, my gut is that we're going to see, before it all falls out, we're going to continue to see a bit of a decrease in building values, probably over the next quarter or two, while there's just not a lot of capital chasing it aggressively at all. Right?
Yeah.
And then I think in certain categories, you might see a reduction in rent as well.
Yeah, but I think there's more of a connection now between buyer and seller on where actually pricing is. You and I have a handful of deals that will trade between late December and call it late January, that'll actually go. So
that's right.
Yeah.
And we were part of that pool that had product that didn't sell and we pulled off market.
Yes.
Right.
Yes. But some of that stuff's coming back around. So it'll be interesting to see. The third topic I want to talk about, and I'd like to have you elaborate on it, is just the lack of the downfall of land values.
Yeah. That one is really hard to pinpoint, as you know, because we're not seeing a lot of trades.
Right.
Really any.
Yeah.
Right. There seems to be buyers out there for it, but construction financing, as you know, is extremely challenging. So debt and equity are challenging on it. Vacancies going up. Construction costs don't seem to be going down. And we don't have comps to really look at what the land value is. And then, of course, your downtime is being underwritten with greater scrutiny. So people are being a lot more conservative. It is really hard to pinpoint land, But I would say in certain parts of the market, I have seen land decrease, to 60%-ish
Yes.
based on the top of the market, right?
Yes, exactly.
Yeah.
And I
Yeah.
think, land would still trade in Kent, for example, today. Like someone's making a bet in Kent today, if you can find the site.
But not at the top of where it was.
Correct. Yeah.
So that might be a 20% discount from top, right?
Yes. Yeah.
And I'm not going to name markets and put people in bad positions that might be sitting on land, but there could be certain markets where, maybe it went from $40 to as much as $18-20, right?
Yeah, if you go further and further south,
right,
that would be the case.
Absolutely.
Another topic to bring up that's definitely trending is subleasing. We've had a lot of subleases come out of late, and we're getting calls from some of our listings that, hey, we're subleasing this space now, right? And so we're seeing certainly the trend of subleasing happening.
Yes, and quarter over quarter, it's certainly surging upwards. We've been tracking this. It's been a topic for, let's say, 5 or 6 straight quarters that we've been watching the numbers. They're now becoming concerning, where they were duplicating before, but, coming out of the pandemic, you almost had no product, right? So if you said we went up 100%, well, 100% going from, say, 300,000 feet to 600,000 feet was not measurable, right? It wasn't significant. Now we're getting to that 3.5 million feet range of product. So now and unfortunately, the majority of that product is hitting the threshold of that 1 to 200,000 square foot range, which I know will be another topic, adding to that. And so that's problematic. So now you've got a good amount of inventory sitting in there and still growing and hitting the wrong product segments.
Yes. So we'll keep an eye on that. That is the next topic I want to talk about, is the 100 to 200,000 square foot range. That's the softest spot in our market right now. Last time I checked, and you may have an updated number, there's 43 options between 100 and 200 in the marketplace. There are some deals.
Update.
What do you got?
So unfortunately...
Don't say it. I don't want to hear it. Yeah.
Unfortunately, we had dropped. You are right.
Yeah.
We went from 49 to 43. In the report that we just ran in the last hour, we were up to 52.
Oh, boy. Yeah.
And that is growing. Several of those were subleases.
Yes.
A couple of them were new product that became available because of tenant move-outs, right? So existing product. So it's a combination, and new construction deliveries, right? So unfortunately, we're dropping down, and now we just took a big step in the wrong direction.
Yeah, there will be a couple deals that get done in that size range. It'll take some of those off, but still, whether that number is 45 or 48, that's not great.
No.
Hopefully Q1 will have a lot of deal velocity in that particular size range. Yeah. So next topic, let's talk about markets in the southern part of the industrial market. Let's talk Lacey and DuPont.
Or south of.
Yeah.
I mean, Lacey DuPont, obviously pre-pandemic, you would have said that was the end of our market with the exception of build-to-suits.
Correct.
Then all of a sudden it ran all the way down to, south of Winlock, really, right?
Yeah. Which I hadn't even heard of Winlock a couple years ago. Yeah.
That's right. So then you would say, okay, there was going to be some spec projects going south of DuPont Lacey, and obviously there were. I would say it's returned, but it's still better. Like, it's not pre-pandemic. It's a market.
Yeah.
It's part of our market. We're tracking that market. I still would not say that, hey, everybody should run down there and build spec unless it's the perfect building, right? And you feel like you've got a reason for tenants to go there and you're bullish, right? I think we're still going to see some spec down that way. And I don't think that's a terrible idea because I think it's a different market, right?
Yeah, you got to build big if you're going south.
I think people that are building small could struggle down that way, no question about it. But I think the market is a viable market post-pandemic. I don't think we return to pre-pandemic what it was, just build-to-suit. I think it's a viable market for large users that want that I-5 corridor in between Seattle, Portland, that are distributing widely to a multi-state area and using the Pacific Northwest and maybe the Port of Tacoma as that shipping portal. And so I think it's a viable area. You just have to be a little bit more careful because we don't have the plethora of large deals running around that we did during the pandemic.
Correct, but we don't have a lot of product, right? We have one building that's basically up right now over 500,000 square feet. So we don't, like a lot of the other West Coast markets, have a lot of big box availability right now.
That's right.
Yeah, that market's doing pretty well. I want to talk about South Seattle as the next topic because it's an interesting little submarket. There's a lot of EV kind of tenant activity in that space right
A
now.
little surge of activity for sure. Tech and EV.
Yes.
Yeah.
Yes. However, that's a concerning market to me because you have, kind of a challenging labor market, high rents, and not a
Politics.
ton of functional product, right?
Yeah.
And you have a lot of homeless issue down there as some of the homelessness that was in downtown got pushed into that market. And so there's issues with tenants not feeling safe down there and not going into buildings because of that. So you're seeing a trend, certainly, and we've seen it from South Seattle tenants move down to the valley. And you have, the 700,000 square foot building going up right now. And so it'll be interesting to see as more product gets delivered in that market. That's the highest submarket vacancy that we have right now because of some of the reasons we outlined. So
closing in on 8%.
Yeah.
Which is crazy. I'm still baffled by how quickly that changed because our entire careers, that was the 1 to 3% vacant market. I think the downturn of kind of '08, it was hovering 4 or 5%, right? So it never got bad. It was always...
It seemed like it's been 3% forever.
Exactly.
Yeah.
And so it's odd to have this. But to your point, I mean, you went through all the reasons why. I don't think the EV and tech's going to save it, right? I think the multi-story thing's a problem because the EV guys need, they need parking, they need ground level, right?
Yeah.
So that's not going up into 65 South Horton. It's not, probably not going to go up into Track 6. And so I think, the multi-story thing, is going to be a little bit of a challenge. And so hopefully tech bails that out and stabilizes those assets. The 700 Trammell Crow asset is a different asset.
Yeah.
Right.
Great building.
Great building. Wonderful design. And so that one, I think, it's interesting on rates, right? So that one's going to set a record at, I think they're asking around $2 on the shell. And so that's somebody that's going to be wanting low drayage close into the port and close into rooftops, right?
Yes, exactly.
And so I think that one will be probably successful.
Yeah, I do too. The question is when,
Yeah.
Right? So,
so one of our topics is on here that might just end up on that one,
well,
right?
You never know. So speaking of, so Boeing's another topic that we want to talk about. They have been our biggest user, our biggest tenant in 2023. Yeah, leasing over, committing to over a couple million square feet, which when we end up looking at our absorption numbers, it'll probably be positive because of Boeing.
Oh, they saved the year.
Yeah.
Yeah. It's weird because our whole careers, Boeing was giving back space, selling space, pulling out of lease space, our whole career, slowly. And then all of a sudden to have them pop a couple million feet with potentially what sounds like maybe another million footer this, maybe in Q1.
Yeah.
Potentially.
Who knows?
So, to have them come in and take 2 million feet when Amazon had a down year, right?
Yeah.
Normally that would have came from Amazon. You would have said, hey, we absorbed 6 million feet plus 2 million of Amazon or whatever it were. But yeah, thanks Boeing.
Yeah.
You did, you did us a favor and saved our year because without you, it would have been a challenging leasing year for sure.
Yeah. You mentioned Amazon. Yeah.
Let's talk Amazon. I mean, all of a sudden it seems like Amazon's back. We're hearing, and of course we don't know any of this for sure, but we're hearing that there may be 4 to 5 kind of plus or minus million square footers on the West Coast that they may be out looking for, maybe potentially one in this market, that one a little bit smaller. But we are hearing a lot of rumblings and we're seeing Amazon in the market. So not just for the big boxes, but for other types of requirements. So welcome back.
Yeah,
to Amazon, we need you.
Yeah, hopefully they'll do some deals and be more active in 24 than they were in 23.
That's right.
Last topic, talk about construction debt.
Yeah, this is a challenge, but it's also needed because the challenge is, demand is down and, we don't want to be overbuilt like we were in '08 where it crashed. So it's probably a good thing that financing became a little bit more challenged and slowed that growth down to keep occupancy up and vacancy down. But it's a challenge. It's a challenge to get financing mostly for construction.
Yeah.
If you're not a well-known entity with excellent relationships and a proven track record, it's not going to be easy, if not yet impossible, anytime soon to get that type of financing. So that is slowing construction down.
It certainly is. But to your point, it'll also help the vacancy rate, stay lower.
Right.
So thank you for listening and watching our podcast. We'll look forward to the next one.
Thank you very much.